Welcome to Talk Tickers. Today, we're digging into Allient's third quarter earnings. And this one, well, it's a real head scratcher. You've got a company that absolutely crushed it, reporting a fantastic quarter, but then the stock gets hammered. So what in the world happened? Let's dive in and unpack the great results and the market's, well, let's just call it an anxious reaction. So here's the puzzle right here. On one side, you have the numbers, and they are good. Adjusted earnings per share beat expectations by more than 20%. Revenue was up double digits, and they hit a record on margins. Just a fantastic report card. But then you look at the other side, and you see the stock's reaction. It dropped over 5% by the close, and at one point during the day, it was down a crazy 17%. So the big question is, why? All right, so to really get why the market freaked out, we first have to appreciate just how strong these numbers actually were. I mean, on paper, this was an absolutely stellar, record-setting quarter for Allient. Okay, let's start with the bottom line. Adjusted earnings per share came in at a whopping 59 cents. Now, Wall Street was looking for 49 cents, so this wasn't just a beat, this blew the consensus estimate right out of the water. That shows some serious earnings power. Now, this is where the story gets really compelling for me. A record gross margin of 33.3%. That's up almost a full 2 percentage points from last year. This tells you they're not just selling more stuff, they are making everything more efficiently and selling a better mix of products. It's a sign of a really well-run operation. And get this is what investors call operating leverage, and it's beautiful. Operating income just exploded, up 84% from last year, while sales only grew 11%. That's exactly what you want to see. Profits are growing way, way faster than sales. So let's just put it all together here. You can see it clear as day. Beats on revenue, beats on adjusted earnings. And just look at the year-over-year growth across the board. I mean, GAAP earnings per share are up 200%. It doesn't matter how you look at it, the company just executed flawlessly this quarter. So where did all this strength come from? Well, this chart tells the story. The big engine here was the industrial segment, making up almost half of the business. And what was driving that? Two things, really. Huge demand for power solutions for data centers and a nice recovery in automation. That's what fueled that 20% growth in the segment. Okay, so the numbers tell us what happened. But what's the story behind the numbers? For that, we've got to tune in to what management was saying on the call. Their whole narrative was about one thing, a clear, disciplined strategy that is absolutely paying off. And the heart of that strategy is this program they have called Simplify to Accelerate Now. It's all about just what it sounds like, cutting down on complexity, making their factories more efficient, and just generally driving costs down. And you know those record margins we just saw? Yeah, this is why. It's working. So on the call, management really hammered home all the good news. They talked about that booming data center business, the amazing profitability, and the incredible cash flow they're generating. And that cash allowed them to pay down debt really fast, which is great. They also pointed out that their aerospace, defense, and medical businesses are holding up really well. But, and you knew there was a but coming, right? This is where the story gets a little messy. They also pointed out some headwinds. Their book-to-bill ratio slipped just below 1. Now, anything under 1 can be a red flag, suggesting that new orders aren't keeping up with what they're shipping out. Then they mentioned a canceled Army tank program, some supply chain issues, and maybe most importantly, they didn't give any hard numbers for future guidance, and that is what the market really latched onto. Okay, so we have all the pieces of the puzzle. Let's connect the dots and finally decode why a great quarter led to such a brutal sell-off. It really comes down to a mix of profit-taking, super high expectations, and a market that is always asking, yeah, but what have you done for me lately? I mean, you really have to ask this question. The stock had more than doubled for the year. It was on an absolute tear. So what on earth could possibly scare people into selling on such a strong report? Well, the answer is all about context. And the first clue is right here. Look at the trading volume. A massive spike on earnings day, almost 3 times the normal amount. This wasn't just a few nervous sellers. This was a high-conviction move. It signals that a lot of investors who rode that huge wave up decided this was their moment to cash in their chips and head for the exit. And this timeline just puts it all in perspective, doesn't it? The stock went on a mind-boggling 150% run in just a few months. Expectations were through the roof. So when the company delivered a great quarter but also dropped those little hints of uncertainty, that book-to-bill, the lack of guidance, It was all the excuse the market needed. The report was an A, but the stock was priced for an A plus with extra credit. So, with all of that as the backdrop, where do we think things go from here? This is the next call, our forward-looking take on Allient. All right, here's our three-step outlook. First, for the next quarter, we think those strong margins are here to stay, thanks to management's hard work. But we do think that top-line sales growth might cool off a bit. Second, the stock price. We think it's probably going to trade sideways for a while, kind of catching its breath around the $48 level, while the market digests this huge run. And that all leads us to our final rating. So our rating on Allient is market perform. Look, the company is doing a fantastic job, no question about it. But after that massive run-up, the stock's valuation seems pretty fair right now. It reflects both the great things they're doing and some of those new uncertainties. We think the easy money has probably been made for now. Now for our trade idea. If you believe in Allient's specific story, but you're maybe a little nervous about the whole industrial economy, you could think about a paired trade. That means going long on Allient stock, while at the same time shorting the big industrial sector ETF, the XLI. The idea is that Allient's unique strengths, especially in data centers, will let it beat its peers, even if the whole sector kind of treads water. And that's our breakdown on Allient. As always, remember, this is not financial advice.